Multiple companies. We see this quite a bit. Directors have not just a single company, they might have two or three for various reasons. If that's you, then consider a salary from each company. That could be beneficial for tax. Not all the time, but it can. So let me explain. And I'll ignore the employment allowance for this for the start. But you pay yourself £12,500 from a company. And let's say you've already used that 12.5 elsewhere. So you've got another company, pay yourself £12,500. You've used your personal allowance, that's going to be subject to tax at 20%. It's not going to be subject to national insurance though, because the national insurance is like per place where you work. So it'll be subject to tax at 20%, but that is then a cost to the business, which reduces profits and reduces corporation tax by between 19 and 25%. So the very worst, you've paid tax at 20%, you've saved corporation tax at 19%. So you've got your money out of the company for 1% versus dividends, which 10.75%. Now you do have to factor in national insurance, because if you've got the employment allowance, and again that's spread between companies where you've got common control, then 12.5 would be a decent amount to pay. If you've got the employment allowance, if you haven't got the employment allowance, it might just be £5,000, which is tax efficient, before you start paying NI. But it's something to really consider on where it's beneficial. And if you've got a spouse, doing the same for them in each of the companies as well. Speak to your accountant, because there are some nuances to it, like everything when it comes to tax.